Hello, everybody, and welcome. It is Friday, May the 6th, on another wild week in the markets and in the world. And I'm excited to be here today with my friend Josh Rhodes from Rhodes to Wealth. Josh, it's great to see you. And
Likewise.
looking forward to having a conversation.
Yeah, and it is Friday. Happy Friday. I spent some time in Austin this week, and like you said, it was even then still tough to keep up. I mean, man, there's lots that I want to cover today. So I'm good to be back.
A lot to talk about.
Yeah. Man, first, I kind of feel not that we were fortune tellers, but we kind of called our shot last time we met. And so I figured we could start there. Let me share with you what I'm thinking. I don't think it didn't take a rocket scientist to figure this one out, but we did talk about it. Originally, Elon was talking about he had made an offer to buy Twitter. Since then, you could see down at the bottom, April 14th, he announced he was going to purchase it. On the 25th, Twitter accepted the deal. $44 billion acquisition. That's $54.20 per share. A 38% premium on what Twitter shares were prior to him announcing, which is pretty sweet little gig if you're a Twitter share owner. Before I move further, and I had maybe a follow-up question or a deeper question I wanted to ask you about this acquisition and where this is at, but maybe just a zoomed out thought. Anything since this announcement that has changed since the last time we spoke? You kind of gave your perspective. You had a little crush on Elon, but anything changed since then, man?
Not much has changed. He did raise some more capital recently from other billionaires. I heard the Binance founder was going to be involved as an example. So look, it's still overall a positive thing. I think that it's eventually has to move beyond a bunch of billionaires owning a platform that the rest of us, are supposed to use as the public square. It's got to get to the point where there's real authenticity and real trust. And hopefully Elon, knowing what he does about blockchain and crypto, will use some of those technologies to give people more mobility and more sovereignty over their assets on Twitter, right? Instead of it just being this place where we just dump our data in and dump our lives in, and then they mine it for things that we don't really understand. And so I'm still cautiously optimistic that that's ultimately where Elon wants to go. Look, he had to finance this. It's a big acquisition. I'm grateful to him for taking it on. And so he's got the benefit of the doubt as far as I'm concerned.
Well, the financing thing, it's funny you went there, is more what I wanted to double click on. And you wrote a really, really good newsletter. This is probably middle of last week, late last week, about this acquisition. And I don't want to steal your thunder at all. Here, the first line, you even mentioned the man crush, which I appreciated. But in this, you had a few concerns. You had maybe even at the end a big suggestion in how folks could get involved or how he could solve this financing issue. And I don't want to steal your thunder. Could you share a little bit about just maybe your thoughts? And we're kind of just future thinking here, but I'd love to have you unpack it a little bit.
Yeah, well, basically what I proposed was a kind of a crowdfunding solution to his financing problem, right? I figured there's 200 million users on Twitter. He needs about $20 billion. So that'd be about $100 a piece. And look, he found a bunch of billionaires to take 7 billion of that. He's bringing it down already. But I think to really let the public in on this, if it's going to be a public forum, the public needs to have a stake in the game. That's fundamental. And that's what's been missing in all of these surveillance capitalism technology business models where the user is the product, right? And not the customer. So look, I appreciate the good intent here, but it never works to just have a few people with good intent try to make things right for everybody. We all have to own this. And so I think that, I took it another step forward and I said, beyond crowdfunding, let's consider a DAO, a decentralized autonomous organization. These are new, right? They're not ready for prime time yet. for the scale of Twitter, but I think the idea is sound, right? And because it really leverages, and at its core, it has a principle of transparency, right? Everybody knows what the rules are. They're literally written in code. I don't think code can govern everything, all right? I'm not a code is law guy, but it's a step in the right direction. Transparency, he's talked about opening up the algorithms, right? Making them open source, showing us what is driving, what gets put in front of us. That's one of the biggest things that people don't understand. You go on Twitter, you go on Facebook, you feel like you have choice, right? Because choices are being presented to you, but it's a narrow set of choices. And those choices, you're being nudged towards choices that ultimately are going to benefit, the profit motive of the corporations or the government, if they have an agenda, et cetera, right? So more transparency, more control over what we see, fewer false choices, right? And more real choices. And so, that's the hope of what something like a DAO could ultimately promise. And I'd like to see some experimentation on that front.
You and I both, and if anyone was going to experiment, I think we've got the captain in the driver's seat. Like it'd be Elon. When I read through this, I circled the question. I was like, I'm going to ask this at the top of the call. I'm going to go clip this and I'm going to see if I can tag him. Like, why not, man? I think it's an interesting idea. And as I read through the math, it's simplified, obviously, and we don't know what we don't know, but the 200 million users, if everyone did $100, there's 20 billion bucks. Like, come on, man. It's interesting. I like it.
Yeah. Did you see also he tweeted a day or two ago about NFTs?
Oh, I have not. No.
And he said, just short tweet. It said, and it was a picture of a Bored Ape and lots of images behind it. And he said, I don't know, seems kind of fungible to me. And it's like, there's no supply constraint, right? Like anybody can make an NFT. So, you can say it's non-fungible because it's unique, but when they're all worth nothing, they're fungible, right?
Totally.
So
I've got I've got something on NFTs. I want to geek out. I'll put a pin in it. Give me one more, and I want to geek out about something in NFTs in a second. Okay. I had one more success story I wanted to share with you. I'm putting in quotation success story. Another announcement from this week. See if I can get this back to you. This is from earlier this week. Airbnb, who we haven't talked about in really a long time since their IPO. Year over year, from Q1 last year to Q1 this year, their numbers surged 70%. It's obviously a release of COVID and businesses
a lot
and people.
In Q1 last year, right?
Yeah, exactly. Yeah. So my question, we haven't talked about these guys since COVID, or since the IPO, and even then, I went back and listened to it. We didn't really talk about Airbnb, the business. We talked about investing at companies at IPO and our thoughts about that. I'm happy to get your take on Airbnb, but really I wanted to get your take on just a point you made of like, there weren't very many people traveling last year, and we are opening things up, and travel does, airline tickets and crew and everything seems to be surging a bit. My question is like, do travel related tickers, stocks, does that type of portfolio, do you have anything, does that interest you at all? Is my question.
I think people wanting to move around and travel and socialize is something that can only be suppressed for so long. So I think it's a good bet that people are going to want to move around. People are going to want to start meeting in person again. People are going to want to start seeing each other, families, people are going to want to travel, right? And now you've got this kind of almost permanent, work from home culture, right? So I think Airbnb is in a pretty sweet spot. And I don't think you can keep people from moving around indefinitely. So not a bad bet.
There's one more question, and I'm going to ask you to geek out on me just for a second.
All right.
I'm going to ask you to explain some finance to me, to us, but personally to me, I'm showing my rookiness. This is, I guess, from last week, earlier this week. Fed, this is in line with market expectations, so this wasn't a surprise, but the headline says that the the biggest hike we've seen in 2 decades, since 2000. And go deeper into the article, you read central bank has talked about, there's even a point down here of maybe 0.2. They've already noticed or noted that they're going to reduce their bond holdings on their $9 trillion balance sheet. We're going to see some quantitative tightening. There's obviously levers that are being pulled to fight inflation here. And I'm curious, obviously, if you had a take on this, like I said, this is in line with market expectations, but really I wanted to ask just sort of if you could talk a little bit about these levers that are being pulled and the impact, like how this has influenced the market. And if you could just share a little bit about what's happening here.
All right. So the Fed raising rates by 0.5 percentage point. So what they're talking about is the overnight lending rate at which banks loan money to each other. Okay. So at the end of each day, banks have to settle up and they have to make sure that they're within the specifications of the Federal Reserve in terms of, their assets and their liabilities. So sometimes they go borrow money from another bank to shore up their balance sheet literally overnight, right? And so the rate at which they borrow that money, the intra-bank lending rate, just overnight lending rate, just went up by 0.5%. Okay. So this is very short-term money, right? This is like 12 hours or 24 hours that they are borrowing this money. So meanwhile, what does that have to do with, borrowing rates at 3 months and 1 year and, 10 years and 30 years, or there's even some 100-year mortgages out there now or bonds out there. So it's actually a very short-term lending rate. I think that's something that people really need to understand, but it's giving a signal, right? It's giving a signal that the cost of money is going up. It's going up on the shortest time frame, and then that pushes it out to go up on the longer time frames because, if you can borrow, you can earn an extra 0.5% lending overnight, right? Then if you're going to borrow money for a longer period of time or loan money for a longer period of time, right? You want more than that. You want to earn more interest. So it has an effect, but mostly it gives a signal. The bigger issue here for the longer term rates is the reduction of the balance sheet. They bought, print money and bought $9 trillion worth of securities, mostly bonds and I think even equities. And so they're going to start selling those, right? We've known that for a while. I think they said they're going to sell like $95 billion a month. For $9 trillion, that would take, 10 years or something to pay down at that rate to get back to zero. So don't expect that anytime soon. But still, it's a lot, $95 billion a month of securities that they're going to be selling, right? They're going to be selling and then they get the money back and then they just kind of wipe it out. They don't keep the money. They don't. But that's downward pressure on the price of bonds, raising up yields, et cetera. So you mentioned the word term signal a couple of times. These are signals. Yep. This may even be an ignorant question. How are you responding as an investor to those signals? Well, you try to anticipate these signals ahead of time as much as possible. So we've been talking about inflation. Totally. It's here to stay. Week over week, right? It's not going away, right? That the Fed is behind the curve. And so, mostly when they actually come out and say these things, you have market reactions. So yesterday or day before yesterday, the Fed came out and did this, and then the market was up 3%, right? On a day where they said, hey, we're making money more expensive, right? And the stock market soars. What was happening there, right? So what was happening was sentiment had gotten to such a negative extreme. There was so much pessimism in the market. So many people were betting on a lower market, right? And then the Fed comes out and it wasn't as bad as we feared, right? They didn't raise 75 basis points. They only raised 50 basis points. Right. And in his press conference, he said 75 points is off the table. So then the market starts to rally, but it rallies mostly because all these people who were expecting the market go down are now seeing the market go up. And for them to stop their pain, they have to buy. they have to buy, right, to get out of their shorts, or because they think, oh my gosh, the bottom's in, I'm going to miss it, if I don't get in now. And so then the algorithms come in at the end of the day, and you just have what's called a classic short squeeze. I expected it to last a little longer than 12 hours, but the next day it reversed completely, and then some. I haven't seen that level of reversal in the markets in a long time. So look, there is tremendous uncertainty in the world right now, period, right? And there's just no getting around it. It's very unsettled. That creates a lot more volatility, a lot more variance. That's where we are right now. Inflation is here to stay. The Fed is behind the curve. They're not going to be able to catch it in the way that they think. That's my core thesis, that that genie is out of the bottle, and that has to color every investment decision we make. So
that's, I asked you to geek out for a second. Now I'm going to ask if you can give me the floor for 60 seconds and allow me to geek out for a second. My next question, have you heard of Americana at all?
No.
Okay.
I love it when you bring these things to me, Josh.
Yeah. Every few weeks, I try to find the beef in the NFT crypto community. And these guys have something, what I feel is kind of cool cooking. Every time we've talked about NFT and the crypto world and what this, digital artists or 3D designers seem to be at the foundation. They seem to be the ones that are getting paid in this type of opportunity. Okay. And there's a huge untapped market outside of 3D designers or digital artists, the physical world, right? And you can see the bar scrolling across. This company has a really unique approach, and they're not live yet. They're announcing their investors this month. The marketplace that they are building will be live in the summer. And the idea, if I could zoom into their world for a second and take you with me, is they've invented this small chip that a designer or a builder, an artist, would put on the back of a physical item, and it turns that physical item into an NFT. So some of the things scrolling across the screen here, as a painter, as an artist, and a physical art, you could put this tag on the back of it. You can see, as far as furniture makers, designers, when you go and get your Pokemon cards actually authenticated and graded, they would put this sticker on the back of it. And first, this tag has GPS and RFID and all the good stuff. But what's really cool about it is it takes this physical item and it puts it on the blockchain, it turns it into an NFT, and it puts it into this marketplace. So first, it gives you the ability to sort of ripple your bragging rights. People buy NFTs, they immediately put them on Twitter.
In a virtual world.
Exactly. Right? So
first,
say, you're increasing
I really own this in the physical world. Here's my virtual analog.
Exactly. So that's the first cool thing, which I thought was interesting.
Yep. Yeah.
More interesting is you put this in a marketplace, and it gives you the ability to sell physical, authentic items on the online marketplace. So it kind of removes the scamminess. And as an NFT, there's an underlying contract that gives the creator 2%, 5%, 10% on that initial sell, on the second and third and fourth and secondhand market sells. So they're always giving back to the original creator, the painter or the designer or the artist. Super cool idea. I'll back out. You could say, hey man, this is ridiculous, move on, but I wanted to get your thoughts.
I think it's an interesting application. I think that you have to watch out for these things taking on inflated prices because of, this illusory benefit, this virtual benefit, right? So I wouldn't want to pay more for a car that I'm going to buy here, right, than I'd want to pay for a car that I'm going to buy somewhere else. But all other things being equal, if I get a car and it's a car that I want to, brag about a bit, and I want an NFT of it, then yeah, it's got some value.
Agreed. I've been stewing on it for 2 or 3 days. I've put it in my little swipe file. I'm going to stick along these guys. And if something exciting happens, I'll bring them back up.
But again, you have to be careful with these things. And, why go to these guys instead of to Carvana, right? Or who knows what.
Sure.
So I do think there's something here. It's got a little more of a community feel to it. The long-term benefit to the artist is cool. And I think it'll catch a wave.
Here's a fun headline for you. Netflix has no chill. This may be the best headline I've ever seen. I loved it. The Netflix, this is maybe it's 2 weeks ago now, but these guys announced that in their first quarter, originally they had thought they were going to take on 2.5 million subscribers in Q1. They ended up losing 200,000 subscribers. So they went the opposite direction. They're expecting, as you can see down here at the bottom, to lose another 2 million customers this quarter, just due to competition. Their stock has, obviously been on a screeching halt. It's down 30% as of last night when I wrote this question. First, man, a fan of Netflix? Do you have any take on these guys, or maybe the streaming community as a whole?
I'm not a fan of Netflix. I think their content has been awful. So I'm just not a fan of what they're doing and what they're producing. When I turn it on, I have to tell my kids to go out of the room until I can get something, up that I am comfortable with them seeing. So I just think that they've done a terrible job. Meanwhile, they have a huge first mover advantage. Can't rule that out. I think they'll recover from this. I hope that they recover from this, that they start to actually produce content that people want to see, and that they don't just play the algorithm game, which I think is costing them now. So they're going to go to an advertising model, which they're talking about doing. I think that's a big mistake. It really puts them into being like Facebook and Google and Amazon, right? Amazon got whacked. Totally. So I think that, and I said this a while ago, Josh, all these companies that just soared during the pandemic, like Zoom and Peloton, et cetera, right? That can be a big problem for a business, because it creates such, unbearable expectations about what you need to be able to do in terms of revenues and growth, et cetera, that you just start doing things that you're not comfortable with, right? And so it gets you into a really tight spot. I think about this as an entrepreneur myself. If somebody came along and said, Richard, here's $100 million, I love your vision, go do it, man. I probably wouldn't say no, but still, it's like, when that, that would be, I'm talking, the way I presented it, it was almost as though there were like no hooks, right? No obligations. And that would be great. That's not the way it works though. When somebody gives you $100 million, right?
Totally.
You have a lot of expectations about what needs to happen, what the outcomes need to be, et cetera, right? So I think all these companies are under tremendous pressure that was artificially induced by the artificial, gains of the pandemic that now have largely evaporated, as people are like, oh man, I actually got to work. I got to travel. I got to, eat. I got to put food on the table. Food prices are soaring, et cetera, right? So I don't particularly feel bad for Netflix.
Yeah.
No, don't get me wrong. But I do think that they'll likely recover from this. And I hope that they don't become just an advertising company like Facebook and Google.
Yeah, I love that you called that out. And when I quickly showed the TechCrunch article, but I've gone down this rabbit hole pretty deeply. And one of the interesting things that I found out is I broke apart the business model. I really enjoy sort of reverse engineering how these guys have gotten to this point. And they set out, the point I want to make is over 100 million households share their Netflix passwords. They share their accounts.
Yeah.
And Netflix was totally aware of that issue, but
they let it happen.
The business model there's this idea of like, well, let's get sticky. We're going to allow folks to share usernames and passwords. And now the idea of they lost 200,000 subscribers in a quarter, there are 100 million households sharing their passwords out there. It's terrible. It's really, really insane.
A company should not do that much damage to shareholders in a 24-hour period. It's just, it's not ethical. And there's something wrong that this happens, right? That you can wipe out $50 billion of equity in one earnings announcement, right?
Insane.
So, and you look at it and like, and that's a systemic problem that they have 1 billion people sharing passwords, right? Probably was in the fine print of their annual reports and their risk disclosures statements. I don't know. I haven't looked at it, but still, like, this was not, they weren't blindsided.
Yeah.
And the fact that the market can let Netflix and other companies get this far ahead of themselves and create those kinds of expectations that are, pretty much impossible to meet. It speaks to me that something's, broken in a deep systemic way. And I'm afraid, it's not going to be the last one that we see before things start to get a little more sane.
Yeah, I'm looking at my time. Do you have time for one more question? Just a follow up on that? Yeah. How I'm kind of teeing you up, but I'm not meaning to, but I want to ask, this isn't the first time we've seen a stock or a group of stocks, tech stocks or something that's taken a major unexpected dip. You talked about Peloton, we talked about GameStop. Some of these are meme-like stocks, but nonetheless, there's this rise and fall. And
just saw Amazon.
Totally. That unexpectedness is, I think, what keeps a lot of individual investors, and I would put myself at times even in that bucket, out of the market and individual tickers and stocks and trying to make decisions. And it makes them just invest in an index fund, or even worse off, makes them just invest in their mattress, right? Like they're just afraid to get in the markets due to noise like this. Again, I know I'm teeing you up, and I'm not meaning to, but it's important to have this answer of, you're building something that I feel, being involved for the last year and a half-ish, that is helping us understand and make decisions, not just off emotion, but we're taking into account volatility and making these risk-based decisions. And I'm asking, knowing what we know, we've talked about Netflix, we talked about Peloton, we've talked about GameStop. Can you talk a little bit about how your app helps navigate these waters?
There's a very simple one, and I actually, I was writing about Netflix a while ago for somebody that wanted my opinion, and I said, looking at my charts, I would guess that Amazon is probably the next one that has the biggest risk of having something like a Facebook or Netflix happen. And what I was looking at was essentially the risk efficiency, right? And I was looking at the stock prices going down, right? So growth is going down and volatility is going up. Right. So when you have growth going down and volatility going up, right, that's a sign that something is not right, in Denmark. And so just looking at that, it's not really happening as much with Google. It's not happening as much with Apple. It's not happening with Microsoft as much, but it was happening with Amazon. And that is what I looked at to say, this is a riskier bet. Amazon's a riskier bet than Apple, Microsoft, or Google right now. And so that is the kind of metric that we are making easily accessible to everyone now. And we call it risk efficiency. You can go look at the growth. You can look at the standard deviation or the volatility too. But all you have to really look at is risk efficiency. If that's fallen below 1, it's a red flag. If it's falling below 0, then it's maybe below 1 is a yellow flag, below 0 is a red flag. And you got a lot of that going on right now, right? At some point, it's going to stop, right? At some point, you will see a reversal. but I don't think we're done yet. And, as I said, inflation is still on the loose, right? Rates are going up. That means that the value of future cash flows, okay, is very discounted. So the money you're going to make in the future is worth less when you have inflation and when you have higher rates and when savers can go earn interest somewhere else instead of having the stock market, be the only, there is no alternative, right? You've heard that acronym TINA. I don't know if you've heard it or not, but it's in, there is no alternative to the stock market. I can't get savings anywhere else. Well, now you can, right? You can get 3% on 10-year notes. And you haven't been able to do that for a while. So that changes the calculus. That changes, the valuation of growth companies. And we're not done with that yet.
No.
And so, the big growth companies will probably survive, but you see little growth companies just being taken out to the woodshed and shot. And that's likely to continue.
For my 35, 40 minutes you gave me, that's what I've got for you, brother. I appreciate the time. Happy Friday. Yeah. And man, thank you for allowing me to be a part of this journey. It's an honor.
Appreciate the questions, Josh. Always great to talk to you. Have a good one.
You too.